With markets currently so volatile, let's look at some of the key features for bear market. Bear markets, or a period where stock markets fall, are an inevitable feature of equity investing. They're also the greatest challenge that investors will face. This is not because of the losses that will be suffered, because these are usually temporary. The biggest challenge is the increased risk of making poor choices during such times. Bear markets often change the decision-making dynamic. In a bear market, smart long-term decisions often look foolish in the short term, whereas in a bull market, foolish long-term decisions often look smart in the short term. Hi, I'm Jayna, a UK-based chartered financial planner with more than 17 years of experience. If you're new to the channel, please hit that subscribe button and the bell icon to stay up to date. If we are to enjoy long-term investment success, we need to be able to navigate periods of stock market decline. There are certain features of bear markets that it pays to remember. 1. They're inevitable. We know that they will happen. We just cannot know when or why. We should accept the fact that bear markets will occur at some point during our journey of long-term investing. In fact, if there were no bear markets at all, the long-term returns from investing in equities would be significantly lower. 2. We won't call the bottom. Market timing is impossible, and this fact does not change during a bear market. The only difference is when portfolio values are falling, the temptation to try and second guess can become overwhelming, and the damage this can cause is likely to be greater than usual. 3. Economic and market news could be conflated and confusing. The temptation to interlace economic developments with the prospects for stock market returns can become irresistible during a bear market. Weak economic news will make us increasingly fearful about markets, despite this relationship being rather negligible. 4. Our time horizons will contract. Bear markets induce panic, which means our time horizons shorten dramatically. We stop worrying about the value of a portfolio in 30 years and start thinking about the next 30 minutes. Being a long-term investor gets even more difficult during a bear market. 5. We won't consider what a bear market really means. In the near term, bear markets are about painful and worry-inducing portfolio losses, but what they really are is a repricing of the long-run cash flows generated by a business. The underlying value of those businesses doesn't change anywhere near as much as a short-term market pricing does. 6. Lower prices are good for long-term savers. So for investors saving for the long term, especially the younger investors starting out, lower market prices are attractive and beneficial to long-term outcomes. It's a different story. It won't feel like it at the time. 7. Some losses won't be temporary. For sensibly diversified long-term investors, the losses from most bear markets should be temporary. There is a long-run premium attached to equity investing after all. But we should not naively assume that everything will recover. Unwise or ill-judged investment decisions will be exposed in a bear market. Inappropriate leverage, unnecessary concentration, or paying eye-wateringly high valuations could result in irreparable damage and could bring about permanent losses that may be impossible to recover from. 8. Emotions will dominate. Our ability to make good long-term decisions during a bear market is severely compromised. Rational thought will be overcome by emotional strains we are likely to feel. What happens if things keep getting worse and I didn't do anything about it? It is during such times that systematic decision making, such as rebalancing and regular saving, come to the force. 9. Our risk tolerance will be examined. Everyone becomes risk averse when they are losing money. After all, it is one thing to be presented a 27% loss as a hypothetical scenario, and a completely different thing to actually live through a 27% loss in your portfolio. This is why, as far as possible, we should avoid reassessing our attitude to risk during tough periods. 10. We will predict. During a bear market, it is hard to see anything ahead but relentless negativity. Our tendency will be to believe that things will be getting worse and that prices will be lower again tomorrow. 11. Each bear market will be different. We should not rely on charts comparing current declines with other bear markets in history. These can be misleading and unhelpful. There is no reason to believe that such deeply complex, unpredictable system should mimic its patterns of the past. Each bear market is unhappy in its own way. Bear markets are the ultimate behavior test. The outcomes of bear markets are more about us than they are about the market. Investors entering a bear market with identical portfolios will have widely different results based on the decisions that they make during it. Bear markets make all the usual challenges of being a long-term investor in equities that much more difficult. The noise of daily market fluctuations will become deafening. We will check our portfolios even more frequently and may find the urge to make short-term trades irresistible. A sensible strategy would be to drown out some of this noise and continue to look at the long term when considering investment decisions. If you like this video and want to learn more, please hit that like button and subscribe to our channel. Thank you for watching, and until next time, I wish you health and wealth.